tariffs are bad for growth, and the uncertainty is very, very bad for growth. And we now have a higher cost of capital because equities are lower, and bond yields are higher than they were. So that will weigh on investment spending and on decision making. This is going to be a weaker period for hiring. So certainly we are looking for the unemployment rate to rise, and we think that will also mean, especially with higher inflation from tariff prices, that real incomes will be squeezed. So it's not just investment spending that will be weaker, but with employment weaker, consumer spending growth will be weaker as well. So yes, these tariffs are going to take a significant toll on growth. We're not going to see anything like the kind of growth rate, even if we're not forecasting a deep recession.
Do you see the impact as being more time limited? What are the kind of long-term parts of that could actually drag sort of as we think further into the future? Well,
I think that's the key question in all of this. How long does this last? This isn't a kind of one-off adjustment in tariffs. If it was 10% on everyone indefinitely, because that's how we're going to raise revenues, and it all happens in April, then a year later it drops out and you haven't got this ongoing uncertainty. But the stop-start nature and the fear that on a daily basis you wake up in the morning and not wondering whether which sectors are going to have 25% tariffs, which countries' tariffs are going to be at 100%, that's where the damage is caused. And we know that there is a broader point to this. The intention of the US president is to relocate manufacturing to the US, but manufacturing only accounts for less than 10% of US employment. It's the damage that will be caused on the other 90% of employment from that much weaker spending. But also he really does want to significantly reduce the relationship between the US and China. And that's where there will be knock-on impacts within the rest of the world. And I think it is longer term. Certainly for the next 2 years ahead of the midterm elections, and there will be significant shifts in global trading relationships, reconfigurations, and look what's already happened in terms of triggering more policy stimulus in China and in Europe. And that's not going into reverse now. The European rearmament and I guess the realization in Europe that they need to do more to support domestic demand in their own economies. This is medium term. It's not just something that's going to be resolved in a few weeks or indeed 90 days.
Janet, on relocating trade or perhaps rebalancing the economy, I'm having a hard time getting my head wrapped around what are the effects of a narrowing trade deficit if Trump gets that, if that's what he's after. I mean, we're still all confused if that's really what he wants. But let's say the trade deficit does narrow. Does that necessarily entail there'll be less investment, via capital account inflows into the U.S.? And does that worry you, or is that off the mark?
He's not going to balance the budget, the trade deficit. Balancing the trade deficit would take a multi-year recession, which is actually what happened in the 1930s when tariffs were at this level. But I think there is an inconsistency of what he's trying to deliver. You cannot have a much narrower trade deficit and have lower bond yields and have a weaker dollar. That is an impossible trinity.
And have a government deficit of 8% of GDP, right? That something has to break there.
Absolutely. He will have to decide, what are his major priorities. And also, as much as countries are queuing up, apparently, to say that they will invest more in the US, and we've had announcements from Japan and Taiwan. Actually, if you are investing now, and remember, a lot of countries have been investing in the US for the last 3 years, helped by the Inflation Reduction Act and the CHIPS Act. But now, if you're building plant in the US, you're paying tariffs on a lot of the building materials and other areas that you are doing. So he is making the costs of producing in the US more expensive, and therefore making a lot of US industry a lot less competitive in global markets. It's all about the domestic market. And you're right, there will be less financial flows into the US, particularly if there are other viable investment opportunities. If the US narrows the the current account deficit, then there'll be less foreign savings to be reinvested into US treasuries.
Where does that money go, I suppose, is the next question. If we're seeing this move away from the US, is Europe attractive enough for that? Will the Chinese stimulus measures help to drive kind of greater growth from there? Where do you see that rebalancing benefiting?
Well, if the US does succeed in narrowing its external balances, then that means the external surpluses elsewhere in the world. So their kind of excess savings that used to all go into the US, actually there'll be less of it. Also, in Europe, there will be more demands on those European savings. And I think this is what we'll even hear from the ECB today, that is about the role of fiscal. We know that at the moment inflation's going to be lower, that we are going to see, perhaps diversion of trade flows. We're seeing the stronger euro, we're seeing the lower oil price on the inflation side. But over the medium term now, and particularly as we go into 2026, you are going to see a lot of those savings going into European investments, and a lot of it will be, whether it's the German infrastructure spending, the European rearmament, and there's still a lot of credibility in US institutions in terms of perhaps not the same yields that you got out of the US, but you don't have the same growth outperformance in the US, and certainty and I guess conviction that the US dollar is going to be persistently strong. Now the euro is actually a bit stronger.